Welcome to the Ontario Mortgage and Real Estate Insights podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, I'm Sandy, your guest host from Keller Williams Legacies here to provide you with insights sourced from reputable news outlets to help you stay informed.
Steve Hamoan here. This is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how our experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today, we're kicking things off with a significant development in the world of mortgages. Fixed mortgage rates are dropping after months of stagnancy. This is big news, especially since fixed rates often don't get as much attention as variable rates. Sandy, what do you think about this change?
Well, Steve, fixed mortgage rates have traditionally been higher than variable rates because they offer stability and peace of mind, as payments remain consistent throughout the mortgage term. But now, the lowest 5-year fixed option in Canada has dropped to 3.79%. This is the lowest we've seen since the spring, and it's just 9 basis points above the lowest 5-year variable rate of 3.7%.
That's right, Sandy. The decrease in fixed rates is largely due to the 5-year Government of Canada bond yield, which has been around 2.6% since October 15th. It even briefly fell to 2.5% on Wednesday. These yields haven't been this low since early April, when investors reacted to trade tensions.
Exactly, Steve. And with the United States Federal Reserve expected to cut rates this month, along with a potential resolution to the U.S. government shutdown, it's no wonder we're seeing these lower bond yields. It's creating a favorable environment for Canadian lenders to discount their fixed-rate mortgage products.
And for borrowers, this means it's a tempting time to lock in a fixed rate, especially since the outlook for variable mortgage rates is a bit uncertain right now. The central bank is expected to cut its benchmark rate by another 25 basis points at its next rate announcement on October 29th. But there's some debate about how things will play out into 2026.
Yes, Steve. The central bank's recent business outlook survey showed some pessimism among business owners regarding hiring and investment, which initially suggested a rate cut was likely. However, September's stronger-than-expected inflation report has cast some doubt on that. Money markets have adjusted the probability of a rate cut from 87% to 77%.
So, whether you're considering a fixed or variable rate, the key takeaway here is to seek out a rate hold or pre-approval. This ensures that you can secure today's lowest rate or best spread to prime, regardless of where the markets head next. It's a strategic move for any mortgage shopper.
Absolutely, Steve. With fixed and variable rates nearly at par, it might be an ideal time for borrowers to lock in. But as always, it's crucial to stay informed and make decisions based on your financial situation and risk tolerance. Let's dive into the upcoming decision by the Bank of Canada, which is expected to cut its overnight interest rate by another 25 basis points on October 29th. Economists are suggesting this move is necessary to support a struggling economy impacted by U.S. tariffs.
That's right, Sandy. The tariffs imposed by the United States on steel, aluminum, and automobiles have significantly hurt Canada's export sector, leading to a 1.6% economic contraction in the second quarter. With unemployment already at a record high, firms are quite pessimistic about investments and hiring.
It's a challenging time, Steve. The Bank of Canada has already implemented 250 basis points in rate cuts, which is one of the most aggressive stances among the G10 countries. It's clear they're trying to provide economic momentum to address the slack in the economy and reduce the unemployment rate.
Avery Schenfeld, the chief economist at CIBC Capital Markets, mentioned that while this might be the last rate cut for now, the central bank could return to rate reductions in 2026 if trade negotiations do not extend the USMCA deal. Losing the current tariff exemptions under this agreement would be a significant risk for Canada.
And looking ahead, a majority of economists, 21 out of 34, predict that the rate will be at 2.25% by the end of next year. This aligns with the lower end of the central bank's estimated neutral rate range, which neither stimulates nor restricts economic activity.
Exactly. But cutting rates beyond 2.25% could be challenging, given the sticky inflation rates and the potential for fiscal policy to ramp up after the federal budget in early November. Abby Shu from RBC noted that moving into outright stimulative levels of interest rates may not be feasible right now.
Despite these challenges, there is some optimism. The Canadian economy likely rebounded last quarter, growing at an annualized 0.5%. It's forecasted to expand by 0.9% this quarter, with an average growth of 1.2% this year and next. However, this is still the lowest growth since the pandemic.
And with the unemployment rate expected to stay near the current 7.1% until at least the second half of next year, it's crucial for policymakers to balance supporting growth while managing inflation, which rose to 2.4% last month. It's a complex scenario, but one that requires careful navigation. Let's take a closer look at the insights shared during the Mortgage Professionals Canada's national conference, where top lenders painted a picture of resilience in the housing market throughout 2025. The general consensus is that, despite higher interest rates, borrowers are adapting well, and brokers are poised to capture a greater share of the market as conditions stabilize.
Absolutely, Steve. The executives from major lenders like First National, Scotiabank, and MCAP highlighted that the market has shown more resilience than expected. Jason Ellis from First National mentioned that arrears are less than 15 basis points, and there's been no sign of a renewal cliff, which speaks volumes about the market's stability.
That's right, Sandy. Brian Carey from MCAP emphasized the need for perspective, pointing out that the Canadian residential mortgage market has grown significantly over the past decade. He noted that while some regions are still facing challenges, areas like Alberta and the Maritimes are seeing steady price increases because they did not experience the same peaks as Toronto and Vancouver did in 2021 and 2022.
It's interesting to see how regional differences play out, Steve. Tracy Gomes from Scotiabank highlighted that borrowers are making disciplined choices and are adjusting well to the higher rate environment. This has led to a healthy switch and refinance market, which is crucial for anyone in the mortgage business.
Indeed, Tracy Gomes also mentioned that the recent federal policy changes, like allowing 30-year amortizations for insured new construction, have made a significant impact on buyer behavior and affordability. Mary Putnam from Canada Guarantee added that these changes have brought more balance to the market, making it easier for first-time homebuyers to enter without feeling pressured to waive conditions.
It's great to hear that these policy changes are providing more flexibility, Steve. Andrew Gilmore from CMLS Financial pointed out that these shifts are helping borrowers move up the credit spectrum without penalties, which is a positive development for the market.
And let's not forget the role of brokers, Sandy. As Andrew Gilmore noted, while Canada's broker share is around 33%, countries like England and Australia have a broker share closer to 75%. This suggests there's substantial room for growth in the broker market here.
Exactly, Steve. Brokers are increasingly becoming a vital part of the mortgage process, offering clients sophisticated advice during critical moments like buying a house or refinancing. As Jason Ellis from First National mentioned, there's a tailwind for brokers as the market continues to grow.
Another interesting point from the panel was on technology and artificial intelligence. Tracy Gomes from Scotiabank discussed how they're using AI for tasks like documentation and application review, which streamlines processes and enhances accuracy. It's exciting to see how technology is evolving in the mortgage space.
Yes, and Andrew Gilmore's analogy of AI as an Iron Man suit for underwriters is quite fitting. It shows how technology can augment human capabilities, making processes more efficient. Jason Ellis emphasized the need for lenders to embrace AI as those who do not risk falling behind. Now let's shift gears and talk about the recent acquisition that has everyone in the mortgage industry buzzing. Neighborhood Holdings has acquired Fiskard Asset Management, a move that was announced at the Mortgage Professionals Canada National Conference. This brings together two major players in Canada's alternative and mortgage investment lending channels, which together serve more than 5,000 brokers.
That's right, Sandy. The new combined entity will be a 65-person organization with almost $800 million under management. Taylor Little, the chief executive officer, mentioned that while they'll operate under the neighborhood brand, the two funds will remain separate, maintaining their unique investor profiles.
It's an interesting consolidation, Steve. Brokers will now see a unified product suite, which should streamline processes. According to Little, there's been some harmonization in underwriting guidelines, which could improve the broker experience. Plus, with a larger business development team, brokers will have more support from sales through to underwriting.
And that's essential in today's market, Sandy. With the alternative lending space becoming more competitive, having a strong support system for brokers can make a big difference. It's also worth noting that Neighborhood's exempt market dealer is being rebranded as Fisgard Capital Management, a nod to Fisgard's established reputation.
Absolutely, Steve. This acquisition seems to be a strategic move rather than a rescue operation. Little pointed out that Fisgard is a strong player in the market with a solid brand and capital, which made it an attractive acquisition. It's refreshing to see a merger that focuses on growth rather than distress.
Exactly, Sandy. And with Jared Stanley continuing as Senior Director of Originations, there's a new Alt-A product on the horizon with no lender fee and direct payment to brokers. This could be a game changer for those selecting the 2-year term, as it promises to add volume without additional costs.
It's a promising development, Steve. However, the alternative lending space is facing challenges, particularly with new FinTrack rules increasing compliance and anti-money laundering responsibilities. Little believes the new combined enterprise is well positioned to handle these challenges, and there might be further mergers as smaller lenders struggle to adapt.
It sounds like a prudent strategy, Sandy. As regulations intensify, companies that can navigate these changes will likely have an edge. Little hinted at the possibility of more acquisitions in the future, which could reshape the landscape of the alternative lending market in Canada.
It's certainly an exciting time for the industry, Steve. This merger not only strengthens Neighborhood's position, but also sets a precedent for other potential mergers. It'll be interesting to see how this impacts brokers and borrowers in the long run.
Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate.
Before you go, a quick reminder. Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your home ownership goals. Catch you next time and stay informed with the latest industry insights.